Welcome back to The Explainer. Look, if you run a business and it's just you, meaning no non-spouse employees, you're sitting on an absolute goldmine of an opportunity. Today, we're demystifying the two heavyweight retirement vehicles specifically built for self-employed individuals. Choosing the right one is a huge strategic move, and honestly, getting this right means you're successfully shielding your hard-earned wealth from taxes while seriously turbocharging your future.
We've got a tight roadmap today. We're going to breeze through retirement for the self-employed, dive into the statutory framework, break down the 2025 contribution limits, figure out which plan wins, cover some critical deadlines and failure modes, and finally, bring it all together with the bottom line.
All right, let's kick things off with Section 1, Retirement for the Self-Employed.
So we're focusing on solopreneur retirement vehicles, namely the Solo 401k and the SEP IRA. Now, these aren't your standard everyday personal IRAs. They are literal powerhouses designed to let you make contributions that far exceed personal limits. We're talking massive immediate year tax deductions or incredible after-tax Roth growth. But here's the catch. They are exclusively for owner-only businesses. If you have non-spouse common law employees on payroll, these specific setups aren't going to work for you. But if you do meet that strict owner-only criteria, you unlock a level of financial leverage that regular W-2 employees can really only dream of.
Moving right along to Section 2, the statutory framework.
To really grasp how these tools operate, we got a peek at the rulebook. Under the IRS tax code, we have IRC Section 401. This is what governs qualified 401k plans, which includes the owner-only variant we usually call the Solo 401k, or sometimes the Uni-K. On the other side, we've got IRC Section 408, and that governs individual retirement arrangements, or IRAs. Mechanically speaking, a SEP IRA is basically just a traditional IRA, but it's funded entirely by the employer. These foundational tax codes are exactly what give each of these plans their unique rules, perks, and limitations. Now, here is where it gets interesting. The core mechanical advantage of the Solo 401k is that it actually lets you wear two hats. First, you put on your employee hat, making an elective deferral straight out of your compensation. Then, you swap that out for your employer hat, where your business makes a profit-sharing contribution right on top of that deferral. This dual contribution structure, it's the absolute engine of the Solo 401k. It lets you aggressively stack contributions from two totally different angles within the exact same business.
But contrast that with a SEP IRA. It is strictly an employer-funded vehicle. You only get to wear one hat. There's absolutely no employee deferral component here. And honestly, this one structural difference dictates almost everything about how these plans perform at different income levels. A SEP IRA relies entirely on a flat percentage of what the business earns, rather than letting you just defer a massive chunk of your own pay right out of the gate.
Let's get into the numbers in Section 3, 2025 contribution limits.
So, for those of you under 50, both of these plans actually cap out at the exact same total limit for 2025, $70,000. But the path to get there is totally different. The Solo 401k lets you drop a massive $23,500 employee deferral right off the bat, plus an employer contribution of up to 25% of your compensation. The SEP IRA, zero employee limit. It relies 100% on that 25% employer calculation to build up the balance.
$70,000. Just let that ceiling sink in for a second. That is a life-changing amount of capital to shield from taxes in a single year. Imagine the snowball effect of compounding that year after year. But actually reaching that 70 grand maximum? Well, that depends entirely on your net business income and which rule book you're playing by.
Now, if you're 50 or older, the Solo 401k pulls ahead even further. Because of catch-up provisions meant to help out late savers, the total limit jumps to $77,500. And if you happen to fall into the new Secure 2.0 sweet spot, ages 60 to 63, it spikes to a massive $81,250. You just have to keep in mind, regardless of your age, both of these plans share a $350,000 compensation cap for 2025 when you're calculating those percentages.
All right, the ultimate showdown. Section 4, which plan wins?
I like to think of the Solo 401k like a high-capacity Swiss Army knife. It's totally feature-rich, it's absolutely perfect for low to moderate incomes because of that massive employee deferral leverage, and it often includes Roth options and the ability to take out participant loans. The SEP IRA, on the other hand, is your trusty, undisputed hammer of simplicity. It's incredibly straightforward, there's no annual Form 5500 easy to file, and you get really flexible funding and establishment deadlines.
To see how this actually plays out in the real world, imagine you have $50,000 in net earnings. With a Solo 401k, you can instantly use your employee deferral to stash away about $23,500. But with a SEP IRA, you're capped at roughly 20% of your net earnings, meaning you max out at only about $9,300. It's the exact same $50,000 of income, but it gives you drastically different contribution power. The solo 401k literally lets you punch way above your weight class when your income is still in that growing phase.
You do have to watch out for the edge cases, though. Like, do you have a W-2 day job on the side? Employee deferrals are per person, not per plan. So if you're already maxing out a 401k at your day job, you completely lose that $23,500 deferral for your own business. And another thing, if your business grows and you hire non-spouse employees, the solo 401k loses its simplified owner-only status and triggers some seriously complex non-discrimination testing. If those scenarios pop up, your entire strategy has to pivot.
Which brings us to the cautionary part of our explainer, Section 5, Deadlines and Failure Modes.
Look, timing is absolutely everything with the IRS. Now, you can fund these accounts up to your tax filing deadline, so March 17th for S-corps and partnerships, and April 15th for sole proprietorships plus any extensions you file. But establishment rules, that's a whole different ballgame. Traditionally, if you want to make an employee deferral to a solo 401k, the plan must be fully established and your deferral formally elected by December 31st of the tax year. Whatever you do, do not wait until spring to set this up, or you might completely lock yourself out of the employee deferral advantage for the whole year.
If you miss these details, you're going to fall right into some really common failure traps. We're talking missing that December 31st establishment deadline, mistakenly trying to fund both a solo 401k and a SEP for the exact same business in the same year, or, and this is a big one, simply forgetting to file Form 5500EZ once your plan assets cross $250,000. That last one trips up so many business owners who started small, set it on autopilot, and just weren't paying attention as their wealth quietly crossed that $250,000 threshold.
But the absolute most painful failure? Over-contributing. Under IRC Section 4973, if you put in too much money, the IRS slaps you with a 6% excise tax on the excess. And trust me, the IRS has a remarkably long memory. That 6% penalty hits you every single year until the excess is actually removed from the account. It's a compounding headache and a persistent drain on your resources. You have to be precise with your accounting here.
Let's wrap this all up in Section 6, the bottom line.
Ultimately, what we have here is a trade-off. You choose the solo 401k for unmatched flexibility, access to Roth buckets, and loan capabilities when you really want maximum leverage, but you have to prepare yourself for strict December 31st deadlines and eventual IRS reporting. Or you choose the SEP IRA if you just want a rock-solid, low-maintenance alternative. Honestly, the SEP is fantastic if your business income is already so high that the 25% employer calculation naturally hits that $70,000 IRS max without you even needing the employee deferral.
But here is the golden rule for everything we've talked about today. Always consult your tax professional before establishing or contributing to a plan. I cannot stress this enough. Because of strict business aggregation rules, weird entity structuring nuances, and IRS limits that seem to constantly shift, your tax advisor is your best friend here. Please, do not guess on your retirement framework. A quick conversation can quite literally save you from years of expensive excise taxes and reporting nightmares.
So, I'll leave you with this to chew on. Which of these powerful rulebooks are you going to adopt to drive your business's future wealth? The high-leverage solo 401k? Or the perfectly streamlined SEP IRA? More importantly, are you ready to commit to the rules, schedule that call with your tax pro, and get the paperwork done before December 31st? Thanks for hanging out and learning with me today, and I'll catch you in the next explainer.